Buying a home is more possible than many people think, and gone are the days of needing tens of thousands of dollars to become a homeowner. Today, you don't need a 20% down payment to purchase real estate with no money. In fact, there are no money down mortgages available to you right now. If you're wondering how to buy a house with no money, keep watching because we have 12 ways to get started immediately, and in order to level up your journey investing in real estate, be sure to subscribe to the channel, turn on post notifications because we post videos every week to help you along the way, so definitely keep watching. 38% of potential buyers say that saving money for a down payment is their biggest obstacle to home ownership. In this day and age, people have found numerous different ways to buy a new home without a whole lot of cash. Consider these 12 steps if you are ready to get started. Number 1. Seller financing. The first proven way to invest in real estate with no money is through seller financing. When buyers are unable to secure a loan from banks and lenders, they may opt to seek real estate financing from the actual sellers themselves. Essentially, you are using the homeowner as the bank, therefore avoiding the entire process of dealing with lender requirements and pre-approval documents. With conventional real estate transactions, the buyers will provide the sellers with the payments and work out their own mortgage plan. This includes monthly payments and interest charges to gain ownership of the property. Basically, the seller extends finances to the buyer, and the buyers will then repay the sellers for the agreed terms. Number 2. Lease options. Under the lease option, the property owner charges the buyer a monthly or yearly premium in the form of higher rental payments. The excess rental fee will then be channeled towards the purchase price. With this type of agreement, the investor can purchase an investment property using a slightly higher rental fee. You could say it's almost similar to seller financing. However, with lease options, there is a bit more flexibility when it comes to coming up with an agreement. Number 3. Hard money lenders. If you have no money to invest in real estate, you can opt for hard money lending as a viable funding option. Instead of coming from a bank, the funds used in real estate investment will come from groups or private individuals. Since these types of loans do not necessarily need to go through corporate procedures, they tend to have fewer qualification requirements. Moreover, private lenders might be more than willing to back up risky projects. Therefore, the interest charged on hard money loans is higher since lenders are taking greater risks and the terms are normally 12 months or less. Hard money loans require the borrower to cover closing costs, application fees, appraisal fees, and any other cost associated with the purchase of the property. Typically, you would immediately refinance out of a hard money loan into a conventional if your intentions are to own the property as a rental unit. Number 4. Microloans. There's a variety of new financing options that have opened up the market for new real estate businesses to profit. As the name suggests, microloans are normally geared towards startups or newer businesses, which require resources to generate further growth. Microloans are much smaller than what traditional financing institutions offer. The lower balances will, in turn, mean these programs are less strict in their qualification requirements. For example, your credit score does not have a major impact on the approval rate. A microloan is a good funding option to invest in real estate with no money. Number 5. Partnerships. Real estate partnerships are common for investing in real estate with little or no money. If you want to invest in a property but the price tag is out of range, then an equity partnership may be what you need. An equity partner is an individual whom you bring into a transaction to help finance the property. There are different ways that partnerships may be structured, and thus it is up to the buyer and the partner to agree on a more viable structure. If you're using someone to provide the cash for a down payment, you should expect to bring some form of value to the table, such as handling the paperwork, property maintenance, and any other active tasks, so you both will provide an equal contribution. Number 6. Home equity loans. If you already have a property and have no money for your second investment in real estate, you can go for home equity loans. The majority of investors tend to capitalize on the equity of their primary home, and then they use it to finance the new property. Banks and several other financial institutions offer different products such as home equity line of credit, also known as a HELOC, and home equity installment loans, which allows the buyers to capitalize on the equity that they already have. Number 7. Real Estate Investment Trust. A REIT is a real estate investment trust. REITs have several advantages, the foremost being liquidity. If you own 20% of an apartment building, you cannot get your money out unless someone else buys your share or the property is sold. When you own shares in a real estate trust, it is generally as easily sold like shares of stock. You can buy targeted real estate investment trusts such as those in firms that build medical buildings, nursing homes, malls, and industrial parks. It is easier to diversify your holdings by owning a variety of REITs, and you never have to manage anything yourself. Number 8. Using money from retirement accounts. Many employers offer a 401k program or similar retirement system where employees contribute part of their pay and the company will match a percentage of those funds. For people that have been at their job a number of years, they may have a nice nest egg put away. If the employer will allow withdrawals from the account, this can be an option to get funds for a down payment on a home. Just be aware that the money will likely have to be paid back if the employee leaves the company. Number 9. USDA Mortgage. To some people, it may sound strange to hear the acronym USDA associated with a mortgage. That acronym stands for the United States Department of Agriculture. This organization offers funding that will allow borrowers to receive a loan equal to 100% of a home's appraised value. In addition, much like the VA mortgage, sellers are allowed to pay the closing cost of the mortgage up to a maximum of 6% of the loan amount. The main caveat to using the USDA mortgage is that the potential home must be within a zone that has been labeled as rural by the USDA. However, that term is a bit misleading to most potential buyers. Most states throughout the country have multiple areas that are zoned as rural. In fact, the outer lying areas of most large cities have at least one area that is a rural zone. Your mortgage lender can look up the address for a potential home and let you know if the property is in the right zone. Number 10. FHA Mortgage. For many years, the FHA Mortgage has been the most popular loan for people buying a home with either little or no money to use as a down payment. The Federal Housing Authority operates in a manner similar to the VA. FHA does not offer the loan but rather gives permission to lenders to provide the mortgages according to certain guidelines. The FHA Mortgage has lenient credit standards and will also allow the seller to pay closing costs. This is much like the VA and USDA loans. The FHA is different in that they do require 3.5% of the purchase price to be paid as a down payment. However, this money does not have to come directly from the borrower. The money may come in the form of a gift from a parent or relative. It can also come from a grant for borrowers that live within cities and counties that offer such programs. Number 11. The VA Home Loan. The VA oversees the rules for lending mortgages to veterans. The VA does not issue the loans itself, but instead grants authority to banks, mortgage lenders, and credit unions to offer VA mortgages. For veterans that meet the proper qualifications, a VA home loan is a great way to purchase a home. First of all, the loan amount can be equal to 100% of the home's appraised value. Secondly, it is possible for the seller to pay up to 6% of the purchase price in closing costs. Third, the VA is not as strict on credit guidelines as some other mortgages. And fourth, the VA home loan guidelines only use one ratio test to determine if the veteran makes enough money to pay for the home, their current debt, and expected living expense. Number 12. Using lender credits. It is actually possible to get the lender to help with part of the down payment and closing costs. Banks, credit unions, and mortgage lenders will charge fees in order to facilitate a mortgage loan. Part of the fee comes from the interest rate charged on the loan. Buyers can negotiate to pay a slightly higher mortgage rate in exchange for the lender using part of the fee to cover some of the closing costs or part of the down payment. This is a discussion that will need to be had directly with the mortgage lender since each loan and each lender operates in a different manner. Buying a house is one of the most important financial decisions that you will make in your lifetime. It can help you build wealth and improve your retirement plan. And in order to learn more about the process of buying a home, check out our playlist we're going to put here at the end that will walk you step by step through each phase of the home buying process. Don't forget to like the video if you enjoy this content and subscribe to the channel for more powerful real estate videos. And until next time, we'll see you guys in the next video.